and cleaning and all the things in our control. We do not have control over people's, their investments, their risky investments, and their back end expenses. So that's just been a little bit challenging to help navigate clients, but that is kind of out of our control. We can't control that our back end, one of our clients has a $7,000 back end expense monthly, so that's just what we're seeing.
Yeah, that makes sense. I think there's a number of markets since COVID that have had a lot more investment buyers, but I think Nashville and Orlando are probably some of and Phoenix. All of the three most oversupplied markets tend to have a much more commercial investment owner pool. We obviously see this in places like Destin and the Panhandle, which are probably where some of the biggest vacation rental companies are. We're starting to see it in the Great Smoky Mountains in Sevierville. There's been a lot more investment there, but that market has never been booming the same way. So they have a lot of like older kind of family properties too. But I would say like Phoenix, Nashville, Orlando has the most amount of these really financial forward people who came in and invested. And especially, I would imagine a lot of these folks came in after COVID. If they invested when you started, they probably are making pretty good money still. Awesome. That's very helpful stuff. Randy, would you want to chime in and let us know what you're seeing in the market?
Yeah,
I know you get a view on a few other things too.
yeah, and I'm going to say that with the Nashville market, and you even touched on the Phoenix market in Scottsdale, with the supply issues that we have, diminished demand, and on the real estate side of it, yes, a lot of people purchased homes in the last 5 years and they paid retail for them. Putting a house together with furnishings and all the fixed costs that go along with it. I was just on a call a half an hour ago with the market, and beautiful, spectacular comp set of 5 bedroom homes. And I'm sure there's a few owners in there that are talking to their management company saying, don't deny any demand. Get that revenue booked because they've got basically a wait at the mailbox for their check to come every month for some of these owners to pay for it. And it's a challenge for that. So if you've got a world-class property, that's fantastic. But if you're not the only one and somebody else is $300 less than you on a weekend, and on top of that, you're behind pace and you have more supply last year, it's a challenging time.
Yeah. A little bit of bright news from a presentation I did with Key Data and AirDNA at the VRMA Executive Summit. Supply nationally is leveling out, but something I've warned against is leveling out is not the same as like going back to what the consumer is. Now, there's a few kind of like truisms. This will be a little different market to market, but in general, travel is still growing across the country and is still growing in most markets. In Nashville, in particular, let me find what I did. Uh, it is Travel is growing. They have forecasted more visitors. They are getting more visitors. Hospitality tax receipts are up and breaking records in Nashville. So if you're looking from the government side, they're like, travel's going great. City's making more money than we've ever made. That looks to continue to grow. Now, that growth isn't necessarily matching the supply because I did pull up a few things. You have two things going on. One is this really large investment in the short-term rental inventory that's going up. That'll probably start to slow down, but it probably won't retract because, if someone bought in and they're underwater, they're probably not in a position to sell it at a loss right now. Or they're just not in a position to sell it. So they're gonna have to hold it for a little bit. So even though that growth may be slowing, it's not gonna start like pulling back to where the consumer is and create that environment of scarcity that really has driven Nashville's uh, you know, highest RevPARs in the nation, definitely pre-COVID, maybe a little bit right after COVID. There's the second component too, which is when Nashville really started to boom as a market, 10, 11 years ago, maybe a little earlier, part of that boom had to do with they had not built new hotels in a very long time in Nashville. There was actually two major markets like that in the country. It was Seattle, Washington, and Nashville, where they really hadn't built new hotels since the 80s. And then the city started to become very, very popular, and there was a huge crunch on hotel rooms. That's the early Airbnb boom in those markets. Obviously, we know that Nashville has maintained that quite a bit and has been very successful for a long time. Seattle responded by banning Airbnbs. So very different response. And I know that because Stay Alfred was originally a Seattle-oriented company. That's where most of the early money was made. And then they got into Nashville as one of the first. So caught that kind of wave very early. Same with New Orleans. New Orleans didn't have the same hotel crunch, but that was another early market. But those two markets had very low hotel supplies about a decade ago. That is not the case anymore. Nashville, has had more than doubling in their hotel supply over the last decade, right? And not only that, Nashville continues to lead the country in the top 10 for new supply coming on over the next few years. This chart, we can't read the article, or one of these I can't read the article, but this one. So this one tells us, from 40,000 in 2014 to 60,000 rooms in 2024. And then this chart shows us that in 2025, they added almost another 4,000 rooms. So, and they're still, for projected incoming hotel supply, they're adding more. They're still at the top. So the supply problem isn't going to go away. It may start to retract a little on the short-term rental side. But if you have any kind of inventory that's going to be competing with hotels, you are going to continue to compete with hotels, right? That supply issue isn't going away. Okay. What's something else that I thought was pretty interesting? This here too, this is a pretty good article. So you guys in Nashville have something kind of cool. Smith Travel Research is based out of Nashville. Does everyone know what Smith Travel Research is?
Yeah.
Yeah.
Unfortunately, way too much. I wish we had it in our industry.
I haven't tapped
Yeah.
into it. I've heard of it. I've dabbled, but it's not a resource we use regularly. But maybe we should.
The data is expensive, so you probably don't need to use the data, but I would definitely follow their like pages and news. They're going to be focused on hotel and real estate. They are owned by CoStar, but they give really interesting information, right? So you saw some of these supply things are CoStar, which owns Smith Travel Research.
Mhm.
This is on CoStar, but they recently had their conference in August. They do that every year. And the reason I pulled it up is I think this is a pretty big deal. At the data conference for hotels, they reported to the nation that they've downgraded their forecasts and that the end of the year is going to be really tough for everybody, right? This is not Nashville specific, but it is, I think, an important thing to note that they do not think performance is going to be good. They specifically mention, and I'll send you these articles after, that the year is going to be really tough across the country for everyone, right? I like to pull up articles like this because one, they give us a little bit of context to the data we're going to look at, but also I think if you have, you guys have to talk to owners and make a case for what's going on. Something from CoStar is going to help your case more than just you telling them what's going on, right? And sometimes people don't always trust revenue management data either because it's so varied. They'd be like, well, how does that match my property? These kind of high level things can help set the stage for what you're trying to tell them when you show the data. Now, one thing I think that's really interesting in this too that they do share with us is this difference in chain scale as well, which is a really big thing. We don't have chain scales in our industry, but chain scales are the way hotels kind of grade in a standardized way the different qualities of the hotels, right? So like a luxury hotel might be the Thompson, a mid-scale might be like a kind of like an extended stay hotel, like a Best Western extended stay. Upper upscale would be like a nice new Embassy Suites, right? Just to give you an idea. And while they see things being much weaker in general, there are some differences here. Luxury is actually up this year. And they're still continuing to expect that to be up. Upper upscale, kind of maintaining, but the farther down you go in the economy bracket, the worse it's getting. And that's something I think we can take for our industry as well. If you have really nice properties, you're probably going to be able to maintain quite a bit better. But if you have stuff in the middle, you're going to be under pressure. And if you have stuff that's at the bottom or really needs a revamp or really just isn't up to snuff, it's probably going to struggle the most. And I think we know that anecdotally, right? if you've got a one bedroom or a studio apartment that just has some like Amazon basics, very basic stuff in it, there's probably a lot of those around you that property has to compete with. If you have a really nice, unique property in a great location, probably still sells itself just fine. Okay, so that's kind of setting the stage on our macro. Unfortunately, not a ton of great news. The good news is demand is still growing. Americans are still traveling. A lot of hotels coming online. So that supply problem isn't going away. But long term, and this is an important thing for sticking into the market, is there is a silver lining to hotel investment and hotel pipeline. It means that the people doing a lot of underwriting still think the market's going to be really strong in the future, right? It's just in the short term, it's going to be a little hard. And then at a national level, the hotel data people are saying this is going to be a tough end of the year. And I think when we look at the Wheelhouse data, we're going to see that too. So before I move on into some Wheelhouse data, does anyone have any questions or comments or thoughts?
Well, I think Nashville might even be a little bit of a unique market only because it's got the leisure and corporate part of the business mix of sales. You've got lots of corporate there. You've got lots of medical there, colleges, lots of other demand than just people going there to go to a honky tonk and listen to, Garth Brooks.
Yeah, that I didn't pull up too much in business. I did see an article while I was looking that group travel is down a little bit in Nashville, which
And the
is
Canadian traffic is kind of gone away.
that was the big thing. So a lot of urban markets around the country right now are suffering much more from the international travel problems. Canadian travel is, for lack of a better term, basically non-existent. I don't think of Nashville as a major international market, although when I was looking, I did see that Canada is their largest inbound international. And if, I'm sure you guys are aware, but that is down like over 70% this year in the United States for inbound Canadian travel. So that's going to be a lot of pressure. When we were looking at, not we here, but me and some other folks were looking at the financial reporting for the public airline companies. Very interestingly, they were very optimistic about what was happening in the sense of their own financials. But when you read into what they were saying, they were optimistic because they were ending routes. They were closing routes. So they were maintaining occupancy by closing routes. That I think from a long-term perspective for
Well,
us, not necessarily a great thing.
that's the little interesting thing about the airlines. You talk to a guy like Scott Kirby at United, he's probably the smartest guy when it comes to scheduling an airline. Unlike the vacation rental industry, we can't pull back our supply during our shoulder and off peak, and an airline can do it at a drop of a hat. They're looking out 6, 9, 12 months and reducing and increasing capacity. People wonder why the airplanes are always full. They shouldn't.
Yeah. So those are a few like those macro things that are kind of interesting. Um, in terms of hopping into this Nashville data, I've got a Wheelhouse report pulled up. So you can see market report's pretty wide range. There's a few listings out here just because they got to fit somewhere, but the majority are going to be in Nashville itself. And just a small thing on the market reports, these are freely available. So there are some limitations on how granular you can get from neighborhood data on this part of the platform, but this is freely available. So if you need some additional data sources or visualizations, you can access this just by logging in. I'm going to start over here on these trends because I think that, for me as a revenue manager, I think looking at occupancies is the best place to start for market data for a few reasons. One, occupancy is essentially a surrogate for demand for us. In hindsight, we can see how the markets are coming together. Two, I also think that occupancy is a really good graph to share with owners. There's like a lot of KPIs that are very complex for a lot of our owners. And normally people can understand an occupancy graph because it's fairly simple. If occupancy is down, probably kind of rough. If occupancy is up, things are probably going fine, right? So I like to use that graph, nice and simple, month over month, year over year. Let me grab a pen out here. And just a little caveat as we look at this, we are looking, oh, I have it set to high, but I want to look at all. We're going to look at, this is looking at all the listings in the market. So this is just a really top level view. And this is something I suggest people do as a revenue manager monthly at least quarterly, which is get a good top level understanding of what you think is happening in the market. If you think things are going well, if you think things are going poorly, do a little write up, communicate that to your owners, support it with some data, and then because that's going to give the context to what you think or what you're presenting as your strategy. Hey, if I think occupancy is under pressure and that's going to continue, we're going to be much more conservative on rate. We're going to drop earlier. We're not going to hold length of stay restrictions. They follow, and if you can communicate that easily, that's really helpful. In addition to that, you want to update that perspective. And that's also where, like, I go do this research outside of the pure data and see, like, is there things that stick out to me that I think may affect us in the future, right? When I was giving presentations like this at a year and a half ago, before things started to go under pressure, I was talking to people about consumer debt or trends that I thought might impact travel to make that case about like why people should be conservative in certain markets.
Mhm.
In terms of what's going on in Nashville, we have a few trends here. The main one, occupancy has been under pressure for most of the year. We see a little bit of a difference in January, February, but that's a low season. And in fact, occupancy starts coming under pressure in February, which is a little different than what happens at a national level. Nationally, across most markets, January, February was pretty good. If we roll back the clock to like DARM or VRMA last year and looked at the presentations, at the end of 2024, things were actually looking pretty good for 2025. Most markets were pacing ahead in occupancy. As we got into January, those were actually actualizing higher occupancies. Now, there was a few little tidbits in there that maybe indicated it wasn't just pure consumer. Even though most markets were pacing ahead, they were doing so at a lower ADR. So that probably means that like enterprise or people were driving more occupancy conservatively. But we did see higher advanced booking at the beginning of the year. Once we hit about March, and it's a little earlier for you guys in February, although being a low season, not everyone would probably notice it. We start to see consistent pressure on the occupancy in the market. And that's true nationwide. March hits most markets around the country, barring ski markets, which are at the end of their season, and a few Q1 high markets. But even those Q1 high markets start to see pressure. We just see consistent pressure. Some of that is due to Easter shifting. But frankly, most markets don't make up the loss for March in April. Sometimes they even lose ground in April. So we see that pressure pretty consistently through May across the country. Once we hit the summer, and you guys are seeing it consistently, we see some differences in trends. So the country starts to change in how they're responding. In the Southeast and the beach markets, we actually see quite a bit of recovery in the summer. They are able to recover their occupancies year over year, sometimes at the expense of ADR. So usually with very little ADR growth or maybe a little ADR attrition, but they do recover that occupancy in the summer across the Panhandle, Florida, a little bit into the Carolina coast and Georgia coast. The Northeast, huge pressure. So all of the markets that are getting significant Canadian travel basically are under massive pressure from an occupancy perspective. They do not recover. When we look at Nashville, we see that those occupancies still aren't really recovering to their year-over-year trends. We'll look at some rate stuff in a bit, but generally that coincides with some rate position drops as well. For you guys, what have you been doing this summer? Like, how has that been coming together for you? What did you have to do to get kind of where you ended up?
I mean, exactly what you just said. I mean, you have to. Our biggest lever is pricing, but we're trying to beat the mysterious algorithm. New photos, trying to test some things out. But really, I mean, we're seeing that pricing is kind of the main driver here. So yeah, it's just more, just like you were saying, John, earlier. Even a little bit post-COVID, we'd be able to hold on to those premiums even further out. So we're just having to get more aggressive and having to get more, just lower rates, just more occupancy driven than ADR driven.
Yep.
Pretty big.
I had a client I worked with really closely that had a property in downtown. It was in Sobro, yes, which had always traditionally done pretty well. It was actually a property that was under my management at Stay Alfred. It was like called the Sobro Guest House. It was like a bunch of little studios, a little bit dated. had always done really well. What I noticed this year in their portfolio, because they've been managing it since COVID, the main thing that really surprised me is like one, all rates dropped, but the weekday occupancy really fell off, and that was the biggest loss in that property. These are little studios, so you can see this competition
Hotels.
with the hotels, right? That property was a property that had maintained around 89% occupancy year round. Now, rates were not high on the weekdays. You know, we're talking like $70 plus cleaning fees, so it's about a hotel room. This year could barely get above 50% on the weekdays.
Wow.
John, that's what I even actually, while I was showing you my notes with the Nashville market in March, April, if we were going to be successful to manage through some of the lack of demand that we're seeing, one of the opportunities that I always look for, which is also the fun opportunity because it's challenging, is what can we do to stimulate demand or shift it? So we put really low rates out Sunday through Wednesday, and now Thursday's the new Tuesday. We had really, really low rates or relatively low rates, long lead times for the summer for Sunday, Monday, Tuesday, Wednesday. And that would be to obviously get what corporate we could get.
Mhm.
We did some experimenting on 1 day minimums. And if we can get any of the leisure demand that is not restricted to weekend travel, I mean, face it, people don't all have to worry about vacation time and work and would prefer to travel weekdays, especially when if they're going to go out during the week, it's not as crowded, it's cheaper. And there wasn't a lot of time where we had excess demand on the weekends, but if we could shift any, that's always fun too. If we can shift some demand off the weekend to go to the weekdays, then we've got maybe a little bit more room for some higher rated people on the weekends, but then you've shifted some. So that's just RevPAR.
Yeah, there's a few strategies that I think like driving weekdays is hard, especially when that demand is under pressure. Randy mentions a big one is like just make sure your price is competitive. There's like this is I think is kind of consistent in these under pressure environments, and I'll show you. Most markets in our space are overpriced on average to the consumer. Like people are at a market level still keep large premiums outside of what I consider to be a pretty short time frame. Sometimes it's only like up to 30 days. Sometimes it's they get out to 60, but usually outside of 60 days, the market's kind of overpriced as a whole, which means there's opportunity to stick out because if you're priced effectively to the consumer, and there's a difference there. You need like we're talking about being priced to what the consumer wants to pay, not necessarily to what like the owners want in their budget. But if you're priced to that consumer, you can take market share because a lot of properties are not really priced effectively to the consumer. They have no way to tell, and they don't start making adjustments until a very short window, like 30 days, sometimes as short as 14, maybe if you're lucky, 60, depending on the property type. Um, so making sure that those low demand periods are just priced effectively year round is really good. That organization that ran the Sobo Guest House, what they did earlier in the year is they did the work to put in long-term stay discounts across all the channels pretty early. So we're talking like 5 night discounts at pretty steep discounts. Like these are low ADRs, but they're not touching the weekend rate really. Um, Mixed results. They're getting some long terms. Ironically, it actually just boosted short booking. I don't know why. I think maybe it's just because the channels like the promotions or people look for stuff, but then they change their plans. But that did boost booking production for them, which was pretty interesting. And then I think there's some strategies that are like almost like they feel like kind of antiquated strategies that are coming back. One, call the people who are on the books and ask if they want a deal on extending their stay, right? Do it when they book, do it before they check in. Those are the 2 times they might be able to make a change to their itinerary, right? Other ones are like, especially in urban markets, if you have the resources to do some, like Randy says, corporate development, that's actually really helpful for a brand. Are there still a lot of cranes in Nashville? Is Nashville still building quite a bit?
Yeah. Yeah.
Go to all the construction sites. They're bringing people in. Every time I've stayed at an Airbnb for a conference for Nashville, there's usually like an Airbnb next door, and it's some group of construction dudes that are in town to do bricklaying or tiling or whatever. Those companies have budgets and they'll put people up for a month or two, right? Or 3 sometimes, or 4, or half a year. And that can
And
be a
John,
really great spot. Yeah.
even before the cranes showed up, when I was with Goodnight Stay, they had the Oracle building going up and they were doing a lot of work on Nissan Stadium.
Hmm.
And we had a general manager in the market, and it doesn't take a rocket science to look at a calendar and realize who's their business and who's there. And we actually sent them out to the construction sites. And you look at the side of these trucks, and if all the electrical trucks match and they might even come from just a neighboring state. You know, you call up HR, it's not hard to find these people on LinkedIn and you say, we see that your trucks are working on the Oracle building, or where are you staying? Can we offer you something? And he's still continuing with those efforts today. And I think he's doing real well there, but that's not that difficult.
And
Takes a
it's
little
very
time.
valuable long term
Yeah.
because those once you establish those relationships, they stay. Um, what Randy's saying, when I was at Stay Offered, we invested in a lot. As you guys know, we had lots and lots of properties, and I'll give you a good example. We had 300 properties in Phoenix. Well, Phoenix in the summer is the deadest dead zone ever. Like we had rates at $45 and we're operating at like a 29% occupancy across June, July, August. One of the best deals we had that helped our revenue in that market is we did what Randy did. Our reservations team looks at the bookings and was like, oh, these are corporate addresses. Let's go figure it out. Hey, there's someone from PetSmart. What are they doing here? Right? It turned out they were interns. So our sales team went and talked to them, and we ended up signing a contract. We hosted their entire summer internship program every year. They
Brilliant.
purchased 40 units from us. The RevPAR that we got from those units, it was a good deal for both. It was twice as high as what we got just selling on the OTAs. We were still running at a loss, but that meant they were also getting a fully furnished apartment for less than what they could have rented the unfurnished apartment for. And it raised our revenue substantially because normally we just forecasted running at a loss. You guys don't usually have periods that are like that here, but the point being, if you look at those reservations for corporate people, just reach out to them and see if they're sending more people. And over time, that builds up, right? This year might be kind of tough. You're just trying to build that relationship, but those people will call you year over year. Or they'll spread your name and you'll start to get another base of business that's outside of just relying on the OTAs and competing with whatever changes are being made there. Um, cool. Well, let's look forward a little bit. And this is something I did pull up some occupancy numbers for the pacing here. I had to do a little calculation, so it's not super obvious. But sorry, I'm looking for my cursor. Um, I did see some concerns here, though, as I pulled up this data. So looking forward, we've got, a little bit on the books for September. Obviously, we're getting pretty far in September, so we're a little, around 2/3 of what was on the books last year, which in my opinion is not really enough, right? This market coming into a higher season should probably have quite a bit more on the books. And when I pulled up the exact pacing, the market is down substantially. We're talking like in the double-digit percentage occupancy behind in pace, which is pretty substantial. Now, September is always a little bit of what I would call a mezzanine period. Even though you build up in Nashville, it's not always the strongest season. And to be frank, pretty much across the country, September is weak. So all of those markets across the Panhandle that were actually able to stabilize over the summer, they've lost it in September. So that is not just unique to you, but September seems very, very weak across most markets I've looked at market data. That is the case here. It is down quite a bit in occupancy pace. We're running out of time. Probably a little late to tell you. Would have been nice if I told you at like the beginning of August, but the answer here is if you're holding any premium, just drive occupancy. Just focus on driving occupancy. Don't spend a ton of time thinking about it, because you can spend a lot of time messing with the rate. At the end of the day, rate's probably collapsing. There's going to be a lot of people unbooked. When we go to October, this is going to be a really key time for you guys, right? This is another high season, especially in the city. October is down quite a bit as well. Not quite in the double digits, but it's pacing behind by about 8% gross. So not like 8% of where we were last year, but just down 8%. This was around 31% last year at this time. So that pacing is really poor as well. And we do have a little bit of time here. And I would say in my own heuristics, we're still a little bit inside of when I would want to start making changes if I were doing the revenue management here. I would want to be making adjustments in response to this probably in August. It's funny, we used to have I used to have the team put Google Calendar reminders on everyone's calendars to make sure to be checking pacing at the beginning of August for the fall for Nashville. But this is probably the key time period where if you're going to spend time adjusting your revenue management, you're going to want to do it in October because one, it's super high value. Two, you still have enough time to make some changes without just slamming it to the ground. And that's where when I say like, hey, in September, don't spend all your time fiddling with September. Just drop those rates, get the occupancy on the books, focus on October because you don't have to collapse your rate position totally to try to get where you need to go. Now, what you do here is going to be a little bit different depending on where you are personally pacing. You know the market is down. You know that the market will probably collapse prices as we go over the next couple of weeks and get within the 2-week window. Your own pacing will determine how much you need to change. If you're pacing really far behind, you need to make some drastic changes and get stuff on the books because it's probably not going to be better in the short term. If you're pacing pretty well, you can be a little bit more conservative, right? So unfortunately, not super great news there. As we get out into November, we are pacing behind a little bit, but this is going to have a little bit shorter booking window as the seasonality turns down. It's not pacing behind near as much as September and October, but it is behind a little bit. And then when we get to December, there's not a ton on the books past that. I would say that the October pacing is a pretty big red flag. How are you guys pacing for October right now?
We're behind last year too.
I'm just gonna check our pace. I know year to date we're pacing down 8% year to date, just portfolio wise. Let me just check October and I'll get back to you.
Okay. While you're pulling that up, I did also look at this for the highest performers in the market. I like to do that just to see if there's differences in trends. It's very common that I do. And I don't know if you guys use Key Data. Key Data does a lot of professionals, and you tend to see that the professionals maintain better than the market at large. But in terms of trends here, we are seeing pretty consistently that that pressure is appearing across the year for the highest performers too. So there's really not a huge difference. They are taking more market share. Overall occupancies are higher. The pacing is actually worse though, when I pulled up the pacing. Now, there's some caveats here. The gross is higher. They are still taking more market share, but they're also not taking as much market share as they had in the past. They're actually pacing a little worse compared to how they were doing, those top performers were doing last year, which is a little bit of a red flag for me too, in the sense that just like this market is under a lot of pressure. And quite frankly, how far people are making changes, I think is going to be really, really important. Just as a kind of a heuristic, how far out do you guys look to make changes when you're kind of adjusting? I know this is different by bedroom count and stuff like that, but how far out are you looking when you do revenue management roughly?
For me, at minimum 3 months, but working with our revenue manager, I would rather look even further out, just like you were talking about adjusting the far out even sooner. But right now we're about 3 months. And just real quick, we're actually pacing 5% above for October.
Good.
Thankfully, but yeah, about 3 months is what but that my revenue managers used to maybe 2 to 3 months, but I want to look further. I'd rather garner those bookings, capture those further out than having to slash rates last minute.
Yeah, I talk to a lot of folks, and if this is like the booking window here, most people spend like the majority of their revenue management time in this short window.
Mm-hmm.
And then if they spend any, they spend very little out here.
Yeah.
Personally, I think it should look more like this.
Mm-hmm.
But it also depends a little bit on the market. I might be working in Nashville properties in the next 30 days, but we've been looking at the first quarter in Scottsdale for quite a while now.
Yeah, definitely by season. I mean, when I ran the revenue management team at Stay Alfred, we had a lot of rules for how far out to look for the high seasons and sometimes the shoulders. Usually the lows we would just keep in the short term and not spend a lot of time. But I think the key here is the amount of time you spend. People spend so much time like dropping the rate over the next 2 weeks. And it's like, just drop the rate go spend your time thinking about where you can make small adjustments and try to figure out where the demand is. Because if you spend all your time agonizing over like whether to drop the rate 30% or 50%, like it's just hit the floor and move past it and then go decide if you can, you know, for October or the upcoming high season, if you drop $5, if that makes a significant change week to week, you know, and make those little iterations. 90 days is pretty good looking out. I would usually say as you're coming into a high season in particular, so for you guys probably like this spring and this fall, you want to start really paying attention to that on a weekly basis, an extra season early. So probably in that like 5 month period is when you just start reporting on it to yourself and checking it and maybe making minor changes. Um, okay. So any questions before I move on from this kind of occupancy information? I'll stay on the occupancy side. I am going to pull up another slice of data. So this is a custom market report I built for downtown Sobro and the Gulch. This is using the Wheelhouse Sets tool. So the Wheelhouse Sets tool kind of allows you to build a custom market report. It's partially free, so you can get to a lot of data. You can also build comp sets in the Sets tool, but there's a paid portion as well. We're happy to provide a trial if you want to try it. There are a few caveats here. I did filter down into this. I'm looking at properties that had at least 60% occupancy last year and were open most of the year. So what I would consider to be like reasonable commercialized properties. And the reason I did pull this up was I did want to just get an idea of where occupancy positions are in just the downtown core year over year compared to, you know, that market report, which is looking at everything, right? To see if there's a significant difference. And there's a few differences that I did see here that I think are important. One, this market is under pressure in the downtown, but not quite as much pressure, particularly early in the year. You can see that Q1 was actually able to maintain in the downtown core and the Gulch and Sobro much better, which kind of makes sense to me. But once we hit summer, we start to see that pressure. Now, there's a lot more on the books for September, but it is still pacing behind in this downtown core. So they're driving a lot more of the market share, obviously, in this core area, but they are still pacing behind across the board, September and October and November. So what I was wondering here is if the downtown is actually really maintaining and it's really like pulling all the business out of the outlying areas that have expanded in Nashville, which I think was what was happening over the few years, a little bit before COVID and also like definitely the last few years. But this is kind of showing us that while downtown definitely takes a much higher market share and was more stable earlier in the year, as we've turned the corner into the second half of the year, the pressure is kind of consistent across the board, really pointing to a much more kind of global problem and not as like, I guess a little different. Does that make sense though? I'm having trouble
Yeah,
describing.
makes sense.
Now I'm going to hop back to here. And I do want to pull up this asking rates one. Asking rates is a metric that I like to pull up with revenue managers. And let me grab this here. Asking rates is the average advertised rate that we see across the channels. So the average advertised rate. That means it can be rates that are booked. It can also be rates that are unbooked. And where adjusted occupancy is kind of a surrogate for demand, asking rates are kind of give us an indicator of how the market is actually responding to that demand, how the supply is operating on the channels, right? And I have this on all. The main thing I think to kind of look at here is despite the fact that the market's under pressure, we're still seeing pretty substantial increases year over year. And this is pretty consistent in most markets around the country. Despite the fact that they're under pressure, the market at large really isn't responding to that via rate. Now, you tend to hear a very different story when you talk to professionals. They actually are paying attention. There's a lot of inventory here that's not being run by an organization that has a lot of experience. There's a lot of individual owners, that kind of thing. And that's where you always, I think, see the markets tend to be a little overpriced. But Nashville is surprisingly not being super responsive to the rate position. You see there is a change though. They do start to adjust. The market is being more responsive as we get into the second half of the year. But again, once you get outside of that like 30-day period, you can really tell that the market's not looking that far out. And what I think that means for a professional and a revenue manager is it really supports that idea of spend your time looking in that 60, 90, 120-day window, because there's actually a lot of properties that just are not priced competitively, probably on accident. And if you can find where the consumer is, you can just take the market share. And that tends to be the story I hear from the professionals in these big markets, which is they're looking much earlier. They're making adjustments much earlier, and they're taking the market share, even though the market's under pressure. And that tends to be what I think is going to be the most valuable thing to do. Now, we're running out of time for the end of the year. October, probably right in the heat. You need to get to it now. You might be able to make some adjustments for November, just making sure your price position is good and making some adjustments and just try to take the market share in that shoulder season. It's probably a little early for Q1, particularly next March. You might make, if you were going to look into next year and you're concerned that next year is going to be a tough year as well, you might check to make sure you're not just putting large premiums in, that your price is reasonable compared to the historicals you would expect. I think that's a good thing to do year round all the time and tends to be something that professional revenue managers do. That's a change as organizations grow. A lot of people have premiums in because they don't have time or resources to be tracking their rates all the time. Once people get into a more professional situation, it's their goal to be competitively priced year round. And usually they tie that to their historicals in some way. They're like, well, hey, I just want to make sure I'm within 10 to 15% of my historical ADRs, right? That can be really beneficial when you look out into Q1 now, because when you look at the market, you can see people just have rates out there and they're substantially higher and they're pumped up. And over time, that'll build up if you're making those reservations. There are people looking. Something that is another really odd, consistent trend this year is even though markets are under pressure, advanced booking is still up across most markets. So really early booking in 2026 is actually up this year for a lot of people and a lot of markets. So there are people looking. It's where we hit that middle window that it's kind of collapsing. And then the short term tends to be strong. But that missing middle is a problem because that's where generally in the past our best rates would have come in volume. But the fact is, when we look at the market, people really aren't thinking about Q1 now. As we get into probably November, if you start thinking about Q1 and making sure you're competitive and looking at it every week, you might really set yourself up for a really good Q1, even if the market continues to be under substantial pressure. Might be a little late for October, but I actually think we're right. If you start right now and really just make sure you're competitively priced and start making small changes, you probably can maintain. Steph, you said you're already up, so you're in a good position to continue doing what you're doing. And you said you look at 90 days, so you're probably already looking at it. And then I would say, even though November is a little bit of a shoulder, that's another spot you want to start to try to drive by just being competitively priced. Now, I do pull up the high performers sometimes. I think the main thing here is you do see that the high performers are being much more reactive towards the end of the year. We see that they are not holding really any premiums through the rest of the year. They're looking out almost as far as December. They've already dropped substantially year over year in September. And when we go into 2026, they're doing what I'm saying. You can see that those competitive adjustments to this year have already been put into place for Q1 of next year. So just a little bit of a kind of like, just to reiterate what I'm saying, the high performers are doing this. They're still under pressure. So I would expect that pressure. I would explain to your owners what's going on in the market. But in order to get that market share where even though these high performers are under pressure, they still are operating at much higher occupancies than the market. They're doing that by looking out almost 6 months and making sure that their revenue management strategy is in place. The markets that have been the most responsive this year, that's a pretty consistent trend, right? Okay, cool. Well, we have about 10 minutes. Does anyone have any comments or kind of questions or thoughts? I'm happy to give you a little bit more from what I know about other markets. If you have something specific to Nashville, I have been in the market quite a bit. So if you had a very specific situation, I'm happy to chat about it. We could also talk about the Airbnb changes, which I think are really interesting and have some implications to everybody.
only thing I'd like to add is I'm getting a lot of clients because we're doing, we're being competitive. So they're lower rates than what owners feel like their property should be booked at, which we all have those clients. I feel like it should be $1,000 net. It's like, I know you feel that way. The market's not reacting that way. So we have a few clients who we've gone pretty low, and they're concerned about perceived value. And that's something that we don't have metrics in place or a way to measure that. So we do have a few clients that are allowing us they're going to take the risk to risk their revenue, and they want to try increasing the rate to look like a perceived value. Can you speak to any, and just so you know, we are more on the luxury side. Our offerings are, they have all the bells and whistles, whatnot. Can you speak to that? Like, I don't even know how to respond to that. For me, I want to make data-driven decisions. Perceived value, I don't know how I can measure that.
It's very difficult.
Yeah.
There's something in this space that I think people take, the benefit of the hotel space here is they have these ideas like chain scale that they all agree on. When we talk about the market or what you compare to, it's exceptionally subjective.
Yeah.
Like there is no objective market, right? Like I can choose to compare to whatever I want here. And value itself is a tough one because this was always a reminder I had with my revenue management team is I really encourage them to not use their perception of value because, and I would give them the example. I live in a weird way. Like I never book a nice hotel room. I will never do it, even if the company is paying for it. I'm not into that. My perception of value is different, but I have other people on my team who would always look for an upper upscale hotel, and I don't have a problem with that, but our perceptions of value are different.
Right.
So I think you can't really explain it. We don't know how the channels are choosing it, but trying to just highlight that, like, if you can find an example to show like the difference in your value and theirs and someone else maybe around, just to show like, hey, value is not an objective thing. That's a subjective thing. And we don't actually know how many people are shopping at any time with different perceptions of value. Now,
John, can I add to that?
yeah.
Steph, I think you're in a very interesting situation. It's a challenging one, and I'm just going to review just a brief minute of some experience that I had. I worked for Fairmont Hotels and Resorts for many years. They had some of the best world-class properties throughout the world. And I started in there, and I had a very proper Englishman as a vice president and general manager. And I'm at the Fairmont Scottsdale Princess. And he came from the London Savoy. I mean, he was just bloody hell, Randy. We're 5-star, 5-diamond. And we started getting in Scottsdale all these casino hotels on the Indian reservations built around us. They're brand new hotels. They are hotels that don't charge $60 resort fee. And I told Karen, I said, we've got to compete with these people because it's just a fact of life. And what we ended up doing was really, really well. We did a lot of off tariff pricing and a lot of prices that people didn't see to build occupancy and revenue. And there was always that question of perceived value because he would ask me, we're 5-star, 5-diamond, and we got resort quality restaurants and stuff like that. Our brunch was $75. This was a long time ago. But what we ended up doing was showing the people back in Toronto the results, the financial results that we got. And all of a sudden, that perceived value wasn't as big of an issue when they started seeing that we were on our star reports. Our RevPAR index was crushing the other Fairmonts, the Biltmores, and some of the other 5-star properties. So, show some results, and all of a sudden,
Right.
those perceived values don't seem as important.
Cool. Thank you. Thank you for that.
On a practical perspective too, I think sometimes you just have to kind of let them do the test. I think that's totally reasonable, which is like, hey, I've shown you market data why I think our strategy is correct, but I totally understand where you're coming from. I've been wrong as a revenue manager. Let's do this. Let's take a time period. We'll let you set the rates. Let's run it for this amount of time, and we'll compare, right? And most of the time, when I am right, that usually works. And if I'm wrong, I'm happy about it because then it means we can charge more.
That's what we're doing. That's it. They're all upfront discussions like, hey, this is our approach. This is not our methodology, but if you want to do that, you take the fall essentially in nicer ways. But okay, well, I appreciate it. I don't want to take too much more time about that, but it all. I'm just glad you guys weren't I was wondering if there was anything else, but we're all aligned, and I agree with everything you said.
Yeah, it's really hard because really nobody knows exactly what the OTAs are doing to
Right.
choose why to show you. We know price is part of it, right?
Yeah.
But I think the one thing is if you know most of your reservations are coming from an OTA, the OTA's goal is to convert a sale. They don't care who it goes to.
Right.
And so even if the value of a property is really high right now, a deal is what a consumer is going to look for. So they will choose a property that they're more sure is going to convert on a deal than its actual value. They really don't care about its what if there was an objective true value of the property, the channels selling it don't care.
Right. Yeah, they're going to make the booking no matter what property it is. They're going to make their commission.
Their goal is to sell to the customer. They don't really care who it gets sold to.
Right. Right.
Cool. Well, I hope you guys found that helpful. We'll send you guys the recording, and I'll also send these links to Edson so you can pull them up if you do want to explain. Sometimes just giving people the top level is helpful. I also like to, people have a lot of cognitive dissonance about their business. So sometimes just drawing a connection between what they think is like, it's the opposite of what I just said, where like value is subjective. It's like, well, remind them how they feel about the economy and ask what they would be doing. Sometimes can be helpful. It was like, I know you think your property should be growing this year, but are you spending more on travel?
Right.
And these can kind of sometimes help with that. In addition, if you are looking for some additional tools, obviously our market reports are free. You can use this. These can be great pictures that you can extract. We do have a wonderful pacing and pickup tool it's kind of like a key data light. It's really designed for fast action on those specific metrics. This is totally free, and we're happy to provide free training on it. And then, of course, if you want to talk about our revenue management platform, we're happy to have that conversation.
John, I got to run. You have a great day, and thanks everybody.
Great to see you, Randy. Awesome, guys. Any other questions for me?
No, appreciate you. Thank you so much.
No problem. Appreciate your time, and you'll probably expect us to do another one in Nashville, probably in January as we get ready for the March booking window.
Awesome. Thanks so much. Take care.
Awesome. Bye, guys.